my biggest concern at the moment is that stimulus is going to be removed too soon, and for very, very understandable reasons. Which is, I think this recession is unique in many respects, but one of the ways in which it's unique is how quickly the fiscal support was enacted and the scale of the fiscal support. And part of the reason the fiscal support came so quickly was because this has been self-induced. So knew we were doing it, and no one was to blame. So there was no fears of sort of moral hazard. In fact, this is a kind of blameless recession. And so the fiscal support came in very, very rapidly, very, very quickly. And as you alluded to, government deficits are getting hit on two fronts. There's a collapse in tax revenues, which we don't really know the magnitude of that yet, but I suspect that'll be colossal. And there is a huge increase in government spending and transfers going on. So they're going to be eye-watering deficits. Now, my own view is we're well placed to cope with that, but that is not the consensus. And that is highly unlikely that the government is going to be able to resist the pressure to tighten policy. The reality is we are going to need stimulus after lockdown is removed, right? So, and I fear that there's a belief out there that once we lift lockdown, we can start unwinding support. I think the support we'll need is of a different variety, but these economies are not going to return to 100% capacity utilization quickly. They're going to return to, at best, 95%. That's still a severe recession in the context of history. So I think you're absolutely right. There's one caveat I would say about markets. I think the signal in markets is a little bit subtler, because if you look at the cyclical sectors, they actually haven't recovered at all, or they haven't recovered very much at all. So if you look at, for example, US banks, which are probably the cyclical indicator, or 10-year treasuries, over the last 5 weeks, they haven't shifted very much. What's happened is the market has actually said there are some winners here, and it's the technology sector. So the market has actually been very discriminating since that kind of liquidity panic in mid to late March.
Well, is there any chance for rotation here? Because, as you point out, Eric, it's been all about the US and it's been all about technology, and yet this unloved bounce from March 23rd that has seen the S&P up over 30% has seen long-short hedge funds return only about 8%, macro only about 1%, and even mutual fund managers who are long, only 40% of them are actually beating the benchmark at the moment here. So what do you need to do from here on in to make money in these markets? What are you doing?
I'm becoming increasingly cautious. So I think so in March, we very, very significantly increased risk. There were lots of opportunities in that extreme phase of liquidity panic. So there were opportunities in credit, even in investment grade, long dated. But here, my predisposition now is to start winding back risk quite materially. And being pretty cautiously positioned. I think this is very, very difficult to read. You're not being paid here, in my opinion, to take on a lot of risk. If you take the S&P 500 as a benchmark, it's down 9% now year to date. What is my upside? Right? I mean, I go back to all-time highs. That's an extraordinarily optimistic scenario, given one of the biggest post-war traumas to our economy, with huge economic uncertainty here, huge uncertainty about what it's going to mean for profits. If you look at the bond market, I actually think bond markets in some sense have been disarmingly rational. And to an active manager, someone like myself, when I look at the risk reward here, I'm really struggling to find it. So I think patience and a pretty prudent portfolio at the current juncture looks right.